Hey everyone, it's July 22nd, 2015. In this week's video, I'll touch base on the US dollar index, the NASDAQ 100 index, and draw your attention to the commodity complex. I want to begin by talking about the US dollar. Since the beginning of summer of last year, all we've seen in the dollar is a top being formed in late March, followed by a consolidation phase. Most technicians would see this as a rising wedge pattern currently being formed. Again, I'm not a really big fan of drawing trend lines. I think I've stated that in every video I've made, and it's simple. Again, the trend lines are drawn to subjectivity and something that more often than not will lead you to make a mistake. So just for that reason, I try to avoid them. But for the purposes of letting you know or for you to have a clear view of what I'm talking about, I've just drawn the trend lines here to show you the rising wedge I'm referring to. I've also labeled or drawn a fib retracement from high to low. And as you can see, the index or the UUP, which is the Power Shares Deutsche Bank US Dollar Index, we've seen the UUP be ranged now between the higher end of the fib retracements, that being the 61.8% fib retracement and the 100% level. I mean, technically speaking, this is bullish. It doesn't turn bearish, or you shouldn't be overly cautious about the US dollar index rolling over unless we break back below the 50% fib retracement level. As of today, we're nowhere near seeing a major rollover of the US dollar index. As you all know, dollar strength is seen as commodity negative, and that's the other point I want to draw your attention to. I mean, if you look at individual names across the whole swath of sectors, be it coal, iron ore, metals, you name it, even oil names, they've been battered and bruised. Some justifiably so, and others have just been, taken down to the woodshed as though they're going to be bankrupt within the next 12 months. If you look at some of the coal names, for instance, a name like Peabody Energy, I mean, this stock has done nothing but go down. Today, effectively being priced at $1.35. Most people would say they're in the very last innings of becoming a public company and possibly having to file for Chapter 11 bankruptcy. So, I mean, that's something you have to be very cautious with. Not too long ago, Alpha Natural Resources, I think it was 2 weeks ago if I'm not mistaken, declared bankruptcy. It's now trading in the pink sheets. This was a name, it was heavily shorted. Something that should be noted is that all these names were heavily shorted in 2012 going into 2013. As these prices basically tumbled, you saw short interest continue to rise as price declined. That's something you rarely see unless there's a very large commitment or somebody in the know knows effectively that some of these companies are in fact going to go bankrupt. Same happened with Walter Energy, another coal company, declared or filed for Chapter 11 bankruptcy about 3 weeks ago. A name like CLD or Cloud Peak Energy, which is a coal-related company, is also trading as though it's going to go bankrupt sometime in the near future. If you look at iron ore, a name like Cliffs Natural Resources, which a lot of firms were bullish on, are now saying that in the event that there was going to if the price of oil were to trade lower down even to the $30 handle, a name like Cliff would survive given that they're not as exposed or as leveraged as some of the other iron ore companies. But lo and behold, it's trading at $2.50, $2.50 today. So investors would beg to differ and say, there's another company that if current trends persist, it's probably going to declare bankruptcy sometime in the near future. You look at metals, they're also trading basically in the dumps. A name like ArcelorMittal, which is an Indian-based metal company, it's trading effectively at the lowest prices in its history. Same with US Steel. Same with AK Steel. I mean, the list goes on and on. You look at consolidated and fairly large companies that have bases of operations worldwide, like Vale. It's also trading effectively at the lowest point in its history. You look at Rio Tinto, same deal. You look at a name like BHP Billiton, is again, all of these names are trading effectively at the lowest levels or one of these lowest levels in their history. What I want to draw your attention to here is on two facts. First, there is opportunity. I mean, it's not as though the entire energy space, whether it be in coal, iron ore, metals, or oil integrated companies, exploration companies, drillers. I mean, it's not as though that space is simply going to disappear. If your investment horizon is 5 to 10 years, if you do your due diligence, you're going to find opportunities in some of these companies within these sectors that you're not going to find anywhere else. I mean, they're as compelling, if not more compelling, than the generational bottom we set in stocks back in 2009. Again, not all names are created equal, and there's going to be a lot more pain inflicted in the very short term before you see the returns that I'm expecting. So what do you want to do? I mean, if you stick with the larger cap names like a BHP Billiton or even a Rio Tinto, you should do fairly well because again, these are all vertically integrated companies that don't experience variation in cost as much as some of the smaller companies. Those are the companies that, whatever happens to the global economy, they're going to be there no matter what. But at the same time, for just on a market cap perspective, you take into account the denominator which you're working with. They're not going to offer you the most or the biggest bang for your buck. You'll have to look at the mid to small cap companies to see which ones are potential takeover targets and which companies could survive on their own. Again, this is going to take a stabilizing and slightly higher price of gold for it to be achieved and improving global demand. I'm of the belief that global demand, specifically for commodity prices, is not going to improve all that dramatically. I mean, we're not going to get close anywhere near where we were in 2004 to 2007 when we saw that mega commodity cycle boom. But, we see demand levels restored 20 to 30% higher 5 to 10 years out, which is fairly reasonable as China and some of the other emerging markets take a bigger role or assume a bigger role in the economic platform. Then some of these names, like again, the smaller mid-cap names, could easily double and some even triple. Again, if you do this, it's true because a lot of these companies, more likely than not, will file for Chapter 11 bankruptcy. So just keep that in mind. So with that said, I just want to end by talking about the NASDAQ 100, which I really to no one's surprise, it's back to trading at new all-time highs. What I found interesting here is the fact that even though we broke out last week quite strongly from the previous range, we're again setting this pattern where effectively we break out higher from the previous range and then spend a considerably long period of time consolidating. The last time we saw such a momentous move in price to the upside was in February. And look what happened. It was essentially set a bullish flag within a rising trendline pattern. And notice that price on a weekly closing basis never closed below the midway point of the pole to this bullish flag. That showed signs of strength and a trend that was quickly maturing. So eventually, if sellers can really push price lower, the only result would be a positive price enactment. So that's what we got. Going forward, for the NASDAQ and the broader markets to trade higher, two things will need to take place. The NASDAQ 100 will need to take out 47.11, which, as you can see, is currently acting as resistance. And the S&P 500, which is still trading or still limited to the current trading range, will have to break out to the upside. Until that happens, you continue to do what you've been doing all along. Fade the rallies, buy the dips on stocks that are fairly liquid and are crowd favorites. And other than that, you have to stay nimble, very active, be on top of the day-to-day events, and recognize the changing circumstances that are taking place today. The one constant I can give you, and I know this for a fact based on some of the other models that I follow, volatility is set to increase from year to year end. So that's something you'll want to take into consideration. Rising volatility, I should mention, does not necessarily mean a weaker market. For all we know, market could remain range bound, just in a trade in a much wider range. So just keep that in mind. So going into next week, again, we would have to see better price improvement to really get excited about the prospects of the market 4 to 6 weeks out. Other than that, just fade the rallies, buy the dips, and stay active and remain nimble. Respect price for what it is, and keep close tabs on price. Don't focus that much on news and the other hoopla that's routinely thrown out everywhere from the internet to cable television. So just stick to what you know, and I'll talk to you next week. Thank you.